What's up, guys? I'm Kay Scholl. Welcome to another financial awareness video. In this video today, I'm going to share with you 6 pretty simple steps to help you get started with making your very own personalized financial plan for retirement. If you find any value throughout this video, then do me a solid and text this video to your husband, your wife, your buddy, or whoever you talk about money with. Really helps out the channel. Step number 1, start with why. If you don't have a purpose behind why you're doing your long-term financial planning for retirement, then it's going to crumble when adversity hits and life gets in the way. And if you're not really sure which direction where you should go with this, then check out Simon Sinek's book called Start With Why. Step number 2, ask yourself this question. In today's dollars, if I was 100% completely debt-free, how much money would I want to hit my checking account every single month in order for me to have the lifestyle that I want to have in retirement? Debt-free, so no credit card debt, no car loan, no student loans, no mortgage, completely 100% debt-free once you're ready to retire. Step number 3, hope you passed 3rd grade because now it's time to do some math. Okay, you then go to this website right here, calculator.net, which I'll link in the description below. Again, this is in today's dollars. So for the sake of this video and this argument, let's just say that you want to aim for $4,000 of net after-tax monthly income, again, assuming all of your debt is completely paid off and you have $4,000 a month to spend. That's $48,000 a year in today's dollars. If you're 35 years old right now and looking to retire at the age of 60, then that will be 25 years of inflation. If you are 40 years old right now and looking to retire at the age of 65, same thing, 25 years worth of inflation. So that would amount to $7,600 of net after-tax monthly income, or about $91,200 per year net after taxes of income. We cannot be 100% certain of where tax brackets are going to be 25 years from right now, but I feel pretty confident in saying they're probably not going down. Okay, we're gonna reverse engineer these numbers right now, so just hang tight with me and double tap this left-hand side of the screen if you have to rewind and watch this a couple times. Here we go. Assuming you are married filing jointly, then that will put you in the 22% tax bracket, which means you'll need, wait for it, approximately $117,000 of gross annual income in order to arrive at your gross monthly income of $9,750, which net after taxes would be $7,600, which will have the same purchasing power as $4,000 per month is right now today. So where's all this money going to come from? Step number 4, list out all of your sources of income. This is where your situation is going to be a little bit unique and different. So use this template of a video and just simply modify or tweak it to your situation. Again, for the sake of argument, we're just assuming that you are married filing jointly and you're going to get 2 paychecks from the Social Security Administration. One of you is going to get $2,200 per month and one of you is going to get $1,800 per month. But that's only $4,000 per month of gross monthly income. You're still only 41% to your goal of needing a total of $9,750 of monthly income. And yes, I'm well aware of everyone's criticism of the Social Security Administration. Yes, it will still be there 25 years from right now. However, if legislation and Congress and our government doesn't act to make any changes, then technically speaking, in the year 2034, I believe, there will only be about 75% of every dollar they're supposed to pay out. So make sure that that $2,200 a month number or $1,800 a month number that we are assuming in this calculation is equal to about 75% of what your Social Security statement is saying it's supposed to be. Okay, so we still need to find $5,750 in order to hit our target goal. Now, some of you will be real estate investors receiving monthly rental real estate income, and other folks watching might be firefighters, police officers, members of the military, or members of municipalities or public service organizations receiving a pension. And if you're in that situation, then you're going to want to make sure that you include those estimated figures in this calculation as well. However, for everyone else that will not be receiving a pension or simply doesn't have the passion to be a landlord, then you're going to have to peel off $5,750 per month from your investment portfolio. Get ready to poop your pants. Step number 5. How much money do I need saved? Well, assuming we go by the 4% rule, which may or may not be accurate, then follow me on this math. $5,750 per month of gross monthly income is $69,000 per year. And again, using this 4% rule, that means you're going to need to have $1,725,000 invested in a pre-tax retirement account in order for you to be able to peel off 4% each year and not touch the principal too much. 1.7 million. Have you pooped your pants yet? Step number 6. How much money do I need to be saving per month over the next 25 years in order to hit my target goal of $1,725,000? Again, your situation is probably going to be a little bit different and unique, but for the sake of this video and this example, you're married filing jointly, and we're going to assume that by the time you and your spouse are 35 years old, when you add up all of your retirement accounts, you've already got $200,000 saved already by the time you're 35. And if you're 40 years old looking to retire at 65, same numbers. You've already got $200,000 saved up by the time you're 40 and looking to retire at 65. This means you have 25 years to accumulate $1,525,000 more bucks. Spoiler alert, it's not as hard as you think. Again, went to calculator.net and got this very simple calculation, and we're just gonna run through this math real quick. Check this out. Assuming you have 25 years to save, and you've already got $200,000 saved, and you need $1.525 million, assuming an average rate of return of 7%, then wait for it, you're only going to need to save $561 per month every month between the age of 35 and 60 or 40 and 65. Congratulations! Welcome to retirement. Listen, check this out. That's $561 per month of all of your total contributions going into your pre-tax account. So that's your 401k contribution, your employer match to your 401k, whatever you're contributing into your traditional IRA, which is pre-tax as well, plus what your spouse or significant other is doing. And hopefully you add it all up and you're hopefully saving more money than that. And in my opinion, I would love for you to do as much after-tax contributions as much as possible so that when you do reach this retirement age of 60 or 65, you've got a hedge of your bets between your pre-tax account and your after-tax account money growing tax-free as well. So that would be your Roth IRA, your Roth 401k, or your solo Roth 401k as well. Okay, so here are my thoughts. First off, if you got any value from this video, then do me a favor and tap that like button and maybe consider sharing it with a buddy. Second, there are so many variables that I did not go over in this video, like taxes. And keep in mind, don't forget, this all started with the premise that you are 100% completely debt-free once you are ready to retire. That means no mortgage, no credit card, no car loans. You're completely debt-free. So if you purchase a new home when you are 45 years old, consider getting a 15-year fixed if you're buying it for your primary residence. I've got a different opinion if you're buying an investment property and you're going to cash flow it. I'm talking primary residence, and we want to make sure that you're completely debt-free. Alternatively, if you don't get a 15-year mortgage when you buy a home at 45 and you get a 20 or 30-year mortgage, then when you are 60 or 65 and you go to get another home and you're going to sell that home, then pay cash for your retirement home. What I would encourage you to do is to save more than $561 per month when you add up all of those contributions between you, your spouse, your employer match, whatever you're doing on your own through your checking account, whether that's to your traditional IRA or to your Roth IRA, because the more money you have saved, the more options you're going to have. You're going to be able to have the option of retiring more comfortably, retiring before the age of 60, or maybe if you really hit the ball out of the park, you could retire and maybe have a second home somewhere. Who knows? And yes, I do know that Social Security won't kick in until at least 62.5. And for a lot of you watching this video, your full retirement age, your full Social Security is going to be at age 67. And I am very much aware of both of those factors. However, this video was just simply a template to help you get started creating a financial plan for yourself. If you'd like to learn more about the Roth IRA versus pre-tax 401k, then check out this video that's going to pop up in a moment. Or if you have a little more time, check out some of my other videos comparing other different retirement accounts to see which one is the best option for you in your scenario. If you have any questions for me, let me know in the comments down below. I appreciate your time. See you in the next one.